Hello everyone, nice to see you again. Um, Hope you're all doing well. We're approaching summer. Could have been a very beautiful time for all of us, but within this period of health crisis, have to be more careful going out, and I think we have to harness this opportunity to study more at home. That Work more from home, having meetings and all sorts of activities that could develop our careers and also businesses. Okay, so our discussion topic today is about the interest rate risk. Okay, interest rate risk, and uh, we are talking about interest rate. It's very interesting, especially in the crisis period. We see lower and lower interest rate. Right, this has been the norm, right? Because during the weak economic situation, the central bank has to lower the interest rate, right, to uh, give energy to the economy, right, to pump money into the economy, to invigorate the economy. But on the other hand, we are seeing, especially in the crisis period, higher gold price and also uh, higher price of government securities, right? Because many people are looking for safe havens, right, for their money and investments. So many people will withdraw money from the capital market, right? That's natural, I think, during the crisis, and they'll put more money into uh, safer investment vehicles such as government securities and gold, something like that. Okay, so let me share my screen. Okay, so interest rate and net worth. This is something very important to financial institutions, because interest rate has been like part of just the daily, and also it is naturally embedded in a financial institution's operation. Um, Here's the thing: when we talk about net worth or equity for a financial institution, um, this carries like a slightly different meaning from that for other types of companies, such as manufacturing or services, right? Because again, when we talk about this in details uh, in our video on capital adequacy, you could see that for financial institutions, um, the equity constitutes a big part of the capital, right? So for manufacturing and other types of company, almost all items at the right-hand side of our balance sheet are considered part of capital. So they are basically capital. Of course, we have some exceptions, right? Some items they are part of liabilities or equity, but they are not capital because they are supplied by non-investors. So they are supplied by people who don't ask something in return. But for financial institutions, only equity and a little slightly or little bit parts of liabilities are considered the capital. So you can watch my video on capital adequacy ratio where we talk uh, in more details about this, right? About the definition of set one capital, and then tier one capital and tier two capital, and of course the total capital. So you see, equity has been like the majority part of a financial institution's capital. That's why this is of a bigger concern, right, to a financial institution compared to other types of company, such as services, manufacturing, food and beverages, and so forth. So when we discuss the interest rate, um, we want to make sure that the change in interest rate or any movement, any volatility or fluctuation in interest rate will not affect our net worth or our equity unfavorably, right? And we have seen a lot of problems from the history, thrift, for example, thrift crisis during 1980s in the United States, right? And uh, but again, a financial institution is always exposed to interest rate risk because of the natural mismatch or mismatches between the assets and liabilities. Right? Okay, see the T-bill, US T-bill rate, and again, government securities are always considered the risk-free rate. And um, we know that a government or central bank could actually go broke, and we have seen some cases in the last decade, such as the case of Greece, right? And maybe some other countries that are approaching bankruptcy. But we know that the government or central bank have a lot of methods or approaches, or you can call it ammunitions, right? Should something bad appear and they need like quick money, right, um, to come back, to like normalcy. Like for example, you could imagine the government could levy higher taxes on its citizens, and then it could, if necessary, it could sell government-owned enterprises, right? State-owned enterprises. It could sell even land, right? We know from history that some countries actually sold their land, right? Like the land of Alaska was sold to the United States, and the state of Illinois was acquired by the United States from France, and yeah, other examples. So again, a government has a lot of ammunitions, right, or methods if it is in a dire need for money and it needs to get the money quickly. Another method might be to print more money, right? Printing more money, uh, and of course this is dangerous because this might create a hyperinflation. But again, a government could choose to do it. Uh, should it really need money in a short period of time? Okay, so Treasury bill in the United States is considered the risk-free rate uh, for the United States and also for the world because of the uh, status of safe haven, right? So every time you see if the global crisis is appearing or is looming, then many investors withdraw money from other parts of the world to go back to the United States to bring the money back to the States because is considered the safe haven for the world investment. Other countries will have different uh, risk-free rate, right? For example, some countries employ the reverse repo rate, maybe 7-day reverse repo rate, right? Or maybe monetary authority rate or some other definitions or categories of the risk-free rate. But we are seeing that the interest rate is moving, right? It's quite uh, fluctuative from time to time, right? Depending on the period of the economic cycle. Okay, so Federal Reserve, again, as the central bank in the United States, uh, will do the like open market operations and some other mechanisms to affect the money supply, inflation, right, interest rate, and uh, all um, all policies related to the monetary power, monetary policy. Right? In Europe, we have the European Central Bank, right? And in other countries, we have our own central banks. Right? And again, the central bank in many parts of the world, in many countries, are responsible for the monetary policy. Right? On the other hand, the government, right, the uh, Department of Treasury or Ministry of Finance is usually uh, responsible for the fiscal policy. So fiscal policy is about uh, revenues and expenses. So in many countries, we are seeing that the government, through the Ministry of Finance or the Department of Secretary, the Department of Treasury, is responsible for fiscal policy. And on the other hand, the central bank is responsible for monetary policy. So fiscal policy is related to revenues and expenses, right? Revenues and expenses of the government. For example, it's about taxation as the major source of income for the country, and then the government expenditures. Right? On the other hand, monetary policy is about the uh, that money supply and then inflation and also exchange rate, something related to like money, right? Monetary policy. So in depending on the country, many central banks in the world are having like the uh, very powerful, uh, authority because it's regulating the monetary policy, and also it plays a function as a monitor or a supervisor of the financial institutions. You can see that in the United States, the Federal Reserve is really powerful because, again, it has the monetary policy power. It regulates the uh, monetary regulations or policies, but it also supervises the financial institutions. So other countries might have like different mechanisms or configurations. For example, the British style, it has a central bank or monetary authority, and also it has a financial services authority. So central bank or the monetary authority and the financial services authority. So the central bank in this kind of style, right, in for example in the UK, it only plays a function as like regulator in terms of monetary policy. It only, in other words, it only holds the monetary power. Right. On the other hand, the Financial Services Authority has the supervisory power of or over financial institutions. Okay, so going back here, you see, like the Federal Reserve or the central bank will do the open market operations, right? It will go to the market uh, to buy or sell government securities. But again, in uh, many countries, the central bank doesn't issue any securities. Also, only the government is issuing debts through securities, right? Through issuing securities. So, you can imagine that in a difficult situation such as today, many central banks in the world will go to the market to purchase government securities, right? So uh, that way is purported to pump money into the economy. You could imagine, right? The central bank is buying government securities, right? So in other words, it's pumping money into the economy because it uses its reserve or its money to buy back the government securities, right? So on the other hand, if the economy is overheating, right, like the growth is so rapid that is approaching overheating level, right? Uh, then the central bank will do the opposite way. So the central bank will uh, try to absorb the money back into the banking system by selling the government securities that it is holding. That you see, right? So we'll talk about this a little bit more during our discussion on the what's that, the credit policy. Okay, so open market operations, and again during the economic crisis, of course, the interest rate will be very low. Right? We have seen this in the last crisis of 2008. So the U.S. government was uh, doing the low interest rate policy, and they call it like quantitative easing, and by uh, like pumping money, more and more money into the economy by purchasing the government securities. So actions mostly target short-term rates, right? Because if the government is changing the basic rate, right? For example, the US T-bill rate or Fed funds rate. So Fed funds rate. So this is the interbank interest rate, right? In a country. So uh, if a bank wants to like borrow a short-term borrowing, right, to get short-term borrowing from another bank, uh, maybe overnight or over several nights, several days, then the interest rate that would be charged would be around the Fed funds rate. So Fed funds rate is obviously affected or enacted by the central bank. And of course, when the Fed funds rate changes, uh, all other interest rates will follow suit, right? So this is, I think, how the financial system is working. From the central bank, when the central bank changes its target rate or its basic rate, then all other interest rates will just follow suit. So it's easier for the central bank and also the financial system in general to target the short-term rates instead of the long-term rates. And uh, I think this is the keyword that we have to be on the one side we are quite happy with this, but on the other hand, we have to be quite cautious because of the globalization of financial markets. So again, if we talk about globalization, we see a lot of positive sides. Right? The level of playing field has been more balanced, right? And the level of learning, right? The depth of learning for everyone, for every country has been quite massive, right? So for example, today we're studying about this, right? The interest rate risk, and again, these materials have been widely available, have been widely discussed, so we don't see like the imbalance of knowledge and practices like we saw in the past. Right? So this, I think, the some positive sides of globalization. But on the other hand, we see uh, that a few negative side or a few drawbacks of globalization. And one of them would be this, you see. So whatever statements given by Jerome Powell, the governor of the Fed, or Christine Lagarde in Europe, will have dramatic effects, will have like contagion effects on all countries. So this is something that didn't really happen in the past. Right? You can imagine in the past, in 1998, there was a big crisis that that attacked some parts of the world, right, from South Korea, Thailand, and then to Southeast Asia. So is more partial, right? So other parts of the world, uh, of course, they were affected, but they were not massively or uh, affected at the same level as the original parts of the world that suffered from the risk or the crisis, right? But you can see what happened like one decade later in 2008, right, to 2010, when the banking crisis started in the United States. That quickly uh, became like contagious to many parts of the world, and let alone today's world, right, in 2020. uh, yeah, you could imagine, right, every crisis will just simply spread throughout the world, right, within seconds, at least within days, right? So this is something that we have to be a bit cautious about, a bit more concerned about this, right? The power of globalization, where even statements by important people in some important countries will quickly spread and quickly affect policies in other countries. Okay, so that's about interest rate. Of course, we need to spend, I think, more time to talk about the concepts and also practices of interest rate in the world, and it's beyond the scope of this video because we're not talking about the like central banking or the what's that the financial services authority and their authorities, their mechanisms, and something like that. But we are here talking about interest rate risk. We just saw the like basic information or the background discussion that leads us to the interest rate risk. Okay, so this is the first one. We're going to talk about repricing model. So repricing model is a classical, an older model that is not an official model ruled by BCBS or Basel Committee for Banking Supervision. So again, this is not an official model uh, postulated by the BCBS. However, this model has been used for a long time, and it could show quickly the position of uh, or an estimate of interest rate risk of a financial institution. That's why it's still relatively useful, right? So in the repricing model, uh, basically we try to estimate the repricing gap for many buckets that we are going to see. So before we go further, we have two definitions here that really define the what's that the situation of a financial institution, why it has an interest rate risk. So if you have a financial institution, uh, let's imagine. So we have a lot of assets, right, and a lot of liabilities. So let's think about it in the most simple, logic. So if you imagine um, the nature of a financial institution, right, you have assets and liabilities, and we get a lot of financing from core deposits, right? The passbook savings, demand deposits, and time deposits, and uh, of course, we could also borrow money by issuing commercial papers or corporate bond and corporate notes and some other vehicles. But again, for a financial institution, core deposits really constitute like a bigger part of the debt financing. And of course, we have to pay interest rate on many types of deposit, right? The time deposit, a little bit on passbook savings, right? And let's say on average, this is like let's say 2%. Okay, this is just an example, right? Of course, it's different from one country to another, But how do we make money? Of course, we make money by lending, right? Lending to entrepreneurs, to corporations, right? To businesses. So we are giving loans, and of course, we charge an interest rate on the loans, right? Let's say we charge on average. We have a lot of assets, we have a lot of liabilities, but let's say on average, we are charging maybe five. So you see that naturally we'll enjoy the uh, the gap, right? Because net interest income of about 3% in this example. Of course, we are talking about averages, right? In both sides, right? Average of the average interest rate on assets and also average interest rate on liabilities. So now imagine, let's say we have a situation that the average maturity of our assets is this long. Again, we are talking about average because we have a lot of assets, maybe hundreds or thousands of loans that we have provided to corporations or entrepreneurs. And on the liability side, the average maturity or length of our liabilities is just the same length of uh, as that of assets. Okay, so if we have this situation, then do we have an interest rate risk? The answer is of course no, right? We'll not suffer from any interest rate risk here because again, you could imagine the average maturity of the assets is exactly the same as the average maturity of liabilities. But of course, in real life, this situation is hardly attained, right? Hardly possible to achieve because how can we, uh, just limit liabilities in order to maintain the same length, right, between the average maturity of assets and that of liabilities. And on the other hand, we couldn't also like limit the lending. Right? Many a time we cannot just uh, limit the lending so that we could have the same average of assets uh, as that of liability. So in real life, this is very difficult to achieve. It's hardly possible to do. But theoretically, we could imagine if we could achieve like this position, then there's no interest rate risk. Why? You could imagine now, uh, on average, when the assets expire and we have to give like new loans to like new corporations or new businesses, at the same time, uh, average liabilities also expire. So that is also the time to look for new financing. So on average, they expire or they mature at the same time. So when we renew the assets and also the liabilities, of course, we could maintain the margin, right? So it's expected that, of course, when we uh, lend out the money to like new people or new entrepreneurs or new businesses, we can maintain the net interest income relative to the interest rate on liabilities that we have to pay. And in this case, we have to renew the liabilities as well. There's no problem with this one, right? No interest rate risk. However, again, in real life, this is very difficult to achieve. It's hardly possible, right? And now in real life, we might have this situation, right? This is the average length or the average maturity of assets, while the average maturity of liabilities is this long. So what is happening now? The average maturity of liabilities is shorter. So on average, liabilities mature earlier. So uh, we have to find like new financing, like new deposits, new liabilities relative to the length of assets. So what is the interest rate risk in this case? What are we afraid of here? The average maturity of liabilities expires or is shorter. So we have to renew the liabilities earlier compared to asset side. So we are concerned, right, that at the time we have to renew the financing, right, to find the financing, the interest rate has gone up. So you could imagine, right now we are enjoying the 3% margin, right? But you don't know, right? When the average maturity of liabilities, uh, you know, is shorter, right? So it expires earlier, and you have to find new financing. Uh, you are afraid or you are concerned that interest rate might go up. So this is called refinancing risk and refinancing risk. Okay, so this is the first type of the what's that? The interest rate risk. And what is, for example, the situation that might appear when you renew your financing? The interest rate has gone up to 3% instead of 2. So now the margin has narrowed to 2%, right? 5 and 3. So the net interest income has narrowed a bit. Right? The other possible situation would be something like this. This is the average maturity of your assets, and this is the average maturity of your liabilities. So this is the opposite situation, right? So the uh, average assets mature earlier than do liabilities. So what is our concern now? Currently, we're enjoying the 3% margin, right? But now the average assets will expire earlier. So we are afraid that when we need to renew the loans, right, to lend money to, again, like providing new loans to entrepreneurs, to businesses, uh, we are concerned or we are afraid that the interest rate will go down. Maybe not 5% anymore, but now it's going down a bit to 4. So again, now we are experiencing a narrower net interest income, right, from 3% to 2%. You see the gap, right? Okay, so this is called reinvestment risk, right? Reinvestment risk. So we are afraid that the when the average assets mature and we have to renew the assets to provide new loans to corporations, to businesses, the interest rate is going down. So it reduces again the net interest income or the gap that we have been enjoying so far. So there are two types again of the potential interest rate risk, refinancing risk, and reinvestment risk. Okay, now for the repricing model, we are going to estimate the repricing gap. Repricing gap. So repricing gap here, this you see the name, as the name suggests, this is a gap, right? A gap between two things here, rate sensitive assets and rate sensitive liabilities. So let's talk about it. So RSA, you see the name here, rate sensitive assets, right? Rate sensitive assets, and RSL is rate sensitive liabilities. Sensitive assets and sensitive liabilities. So again, as the name suggests, you could imagine the RSA, rate sensitive assets. Rate sensitive assets mean that these are assets or the amount of assets that will experience a change in interest rate within a certain period of time or within a certain bucket that we are going to see. You could make any bucket period that you want, maybe 1 day bucket, 1 week bucket, 1 month bucket. 1 year bucket, even 5 year bucket if you want, or 10-year bucket. Uh, so rate sensitive assets, once again, these are assets or the amount of assets that will experience a change in interest rate within a specified period of time. And what is RSL? Of course, this is like equivalent, like uh, uh, the same logic here. Rate sensitive liabilities. So these are liabilities or the amount of liabilities that will experience a change in interest rate within a specified or specific period of time. Okay, so to make it easier to imagine, let's see an example here. So you could make any category of bucket at 1 day, then 1 day to 3 months, 3 months to 6 months, and so forth, right? So you could make uh, any bucket period that you want. So see an example here. Let's say 1 day bucket. So what's the meaning of 1 day bucket? Of this is RSA, this is RSL. So what is the meaning of 1 day bucket? Right? RSA for the 1 day bucket is 20 million. And this is in million. So what is the meaning then? If we say that the rate sensitive assets for the 1 day bucket is 20 million. So you could imagine again, RSA is again the amount of assets that will experience a change in interest rate or will be affected by the change in interest rate within a specific or a specified period of time. So in this case, it's 1 day, right? 1 day bucket. So you could imagine the amount of assets that will experience a change in interest rate or will be affected by the change in interest rate in 1 day is 20 million, right? What about the RSL? RSL is 30 million, which means that the amount of liabilities that will experience a change in interest rate in 1 day is 30 million. And of course, the repricing gap, right? Repricing gap is RSA minus RSL. So the repricing gap is minus 10. And the cumulative is also minus 10. So let's uh, try another example. What if I ask you, what is the uh, repricing gap of 1 year? So be careful, repricing gap of 1 year. Uh, you see this one is 6 months to 12 months. So if I say, what is the repricing gap for 1 year? Then you have to include everything, right? Because 1 year includes 1 day, 3 months, 6 months, and anything, right? Within 1 year. So you see this one, you have to differentiate 1 year with this one. This one is a bucket between 6 months to 12 months only. So if I say, what is the repricing gap for 1 year? Then this is everything from 1 day to 12 months. Right? So what is the RSA? You can calculate here 20, 30, 70, and 90. So it's about 210, right? So the RSA of 1 year is 210. And what is the meaning again? The amount of assets that will experience a change in interest rate in 1 year is 210 million. Okay, so what about the RSL of 1 year? There's 30, 40, 85, and 70. So this is about 225, okay? 225. So RSL for 1 year bucket is 225. Again, what is the meaning of this? The amount of liabilities that will experience a change in interest rate in 1 year is 225. So what is the repricing gap? It's minus 15. I can see here at minus 15. That is the repricing gap for 1 year bucket. Okay, so how to apply the repricing gap or the repricing model here? Uh, so yeah, we care about the See, we just discussed it some minutes ago. We are concerned about the net interest income. So if it's going up, we are happy, right? But if it's going down, we are unhappy. So we are concerned about the change in the net interest income, right? And how to measure this one? How to measure it? We just see the repricing gap, right? So repricing gap is RSA minus RSL, right, multiplied by the change in the interest rate. Okay, so we could estimate the change in the net interest income as the repricing gap multiplied by the change in interest rate. We see an example here. For the one-day bucket, at one-day bucket, we look back here. One-day bucket, RSA is 20, RSL is 30, so the pricing gap is minus 10. And if you're afraid of an increasing interest rate by 1%, so the delta R is 1%. So with this repricing model, we could estimate that the change in net interest income would be, this is RSA minus RSL multiplied by the change in interest rate. And in this case, you are afraid that the interest rate will increase by 1%. So your net interest income will be lower by 100,000. So you see here's the sad thing, right? You didn't do anything wrong. You serve your customers well. Even you got like a lot of new clients, right? You have provided new loans to many other corporations and so forth. But suddenly your net interest income is suffering, right? Is uh, retracting by 100,000 without you making like any mistake, right? But again, in the modern times, if you do nothing, you still take the blame, right? Because you do nothing to hedge against the interest rate risk. Okay, so what about 1 year gap that we estimated before? What is the 1 year gap again? This is 210. 1 year gap is 225. So the gap is minus 15, right? So the repricing gap for 1 year bucket is minus 15, right? And if you're afraid of an increasing interest rate by 1%, then your net interest income might decline by 150,000. Again, this is an unfavorable position, and actually you might do nothing wrong, right? But then you have to hedge against the interest rate risk by measuring this. Okay, so let's see an example here. We have a hypothetical balance sheet, and we are looking for the like 1 year bucket. So let's do it one by one, right? Short-term consumer loans, 1 year maturity. This is definitely included, right, in a 1 year bucket. Long-term consumer loans, 2 year maturity. This is not included in the 1 year bucket. 3 month T-bills, yes. 6 month T-notes, yes. 3 year T-bonds, not included in the 1 year bucket. 10-year fixed rate mortgages, of course not. And point number 7 is quite interesting. 30-year floating rate mortgages, but the rate is adjusted every 9 months. So this is yes. This is included into the 1 year bucket. I'll read it carefully again. This is a 30-year floating rate mortgages where the interest rate is adjusted every 9 months. So this is included. So we could add them up. The 155. Okay. What about the liability side, liabilities and equity? Equity capital is definitely not RSL, right? So we are looking for RSL for 1 year, right? Equity, this is not liabilities, right? Not So definitely this is not included because it's equity and it's not rate sensitive. So demand deposits and passbook savings. So these two require further discussions. You could imagine that demand deposit. I hope you're familiar with demand deposit. The another name for it is checking account. So demand deposit. This is a checking account, right? So somebody goes to our bank, he or she is opening a demand deposit account or checking account, meaning that he or she could withdraw money using or by writing a check, right? So you see the checkbook, he or she could write a check and give it to uh, anyone or any store or any business, right? So because of its flexibility, right, of anytime withdrawal um, without any complication, just withdrawing money using a checkbook or with writing a check. So demand deposit usually carries zero interest rate. So what is the consequence here? If the interest rate is zero or close to zero, then demand deposit could be considered not rate sensitive, right? Not rate sensitive, okay, because it's zero or close to zero. So we could consider demand deposit to be not rate sensitive, right? What about the passbook savings? Passbook saving is the same thing, quite similar. Passbook saving, you could imagine this is like normal saving that everyone has, I believe, right? So we go to a bank, we open a saving account. Uh, of course, in modern times, we could withdraw money with the ATM card, even with credit card attached to that savings account. uh, or you could like, traditionally go to the bank to withdraw money manually. But again, because of its flexibility, usually the interest rate is quite low, maybe 1%, 1 to 2%, and most likely this type of account will not be affected too much by the interest rate fluctuation. So again, most likely we could consider this one not rate sensitive. Not rate sensitive. However, now this is an important, I think, an important note to both accounts. Okay, so although demand deposit account and passbook savings account are not really rate sensitive because they are not sensitive to interest rate changes, but think about it. In a difficult time, um, maybe different, sorry, maybe difficult uh, economic situations, um, like crisis period, or if the crisis is looming, or there are bad rumors about the financial institutions or financial institution industry, or uh, bad forecast or projection about the economy and something like that. Many people might, go to their banks and withdraw money in massive amount. So we call it a bank rush, or bank run. So they come to their banks to withdraw a lot of money simultaneously, right? So as a financial institution, we might suffer from this problem, right? Suddenly, we have the deposit drain. We call it deposit drain, meaning that the core deposits that we have are suddenly drained by the depositors because of, again, the economic situation or the bad rumors or bad forecast, right? So suddenly we are losing demand deposits and passbook savings in huge amount. And again, we realize that these two accounts actually provide cheap financing for us. So we love them a lot because they provide like cheap financing to our financial institution. And if we lose we lose them, that means that we are losing cheap financing. And imagine if we are losing this cheap financing, we have to replace them with something else. And that something else might not be free like this, right? Might not be as cheap as these two. And so, in other words, if we lose this cheap financing, we have to replace them with more costly financing. So that being the case, it becomes more complicated to define these two. Okay, so again, they are not rate sensitive, but we have to realize that if we lose them because of the economic situations, uh, then we have to replace them with more costly financing, right? So I think the best way to reconcile this would be to include these two accounts uh, in like a longer bucket, maybe in a 5-year bucket, or at least in a 1-year bucket, right? Or maybe slightly longer than 1 year, maybe 2 years or 5 years or something like that. Okay, so we go back to our story here. So because this is a 1-year bucket, we will not consider these two to be rate sensitive liabilities. So they are not part of the RSL for the 1-year bucket. 3-month CD, of course, yes. 3-month bankers acceptances, definitely yes. 6-month commercial paper, of course, yes. 1-year time deposit, yes. 2-year time deposit, not 1-year bucket. Right? So we sum them together, we get 140. Right? So the repricing gap for 1-year bucket is 15 in this example. You could state also repricing gap in ratio, we call it gap ratio. So this is the uh, repricing gap divided by the assets, right? Just relative to the size of the assets. So in our example here, the repricing gap for 1 year is 15, and the total assets is 270. So the ratio is 5.6%. This is just another way of defining the what's that the repricing gap in terms of ratio. And you see in an example here, Security Federal Corp, we see so many buckets here, even a longer bucket like 5 to 10 years, over 10 years, right? You can see the buckets here, the gap, the repricing gap, and also the cumulative gap from time to time, right? So you can see the gaps for many buckets here. So what about the favorable and unfavorable position? So again, you see here the net interest income, so the delta, the change in net interest income can be measured as the repricing gap. This is what RSA minus RSL multiplied by the change in interest rate. Okay, so in our example, the cumulative gap or the repricing gap for 1 year is 15 million. We saw it just now. 155 minus 140, 15 million. And if you are afraid that the interest rate will increase by 1%, right? So based on your projection, the interest rate will go up by 1%, and your repricing gap is positive 15 million, then you would expect an increase in the net interest income of 150,000. So this is good news, right? This is good news. So you can see the relationship now. If the uh, repricing gap is positive, then uh, an expectation of increasing interest rate will increase our net interest income. Now, on the other hand, if the repricing gap is negative, then the an increasing interest rate will lower our net interest income. Okay, so we can see here there are four scenarios here, very easy scenarios. We see the first one, Okay, the first one, the gap is positive. So you imagine the situation, RSA is bigger than RSL. Okay, and uh, the interest rate is going up. So I would try to, inspire you using very slow and manual thought, line of thought. Okay, so think about it, right? If the interest rate is going up, right, and this is your RSA. Uh, Again, what is RSA? RSA means this is the amount of assets that will experience a change in interest rate, right, within that period of time. So if interest rate is going up and your assets expire, you won't you will also you will renew your assets at a higher interest rate. Agree, right? So if the assets expire or mature, uh, you have to renew the assets, right, by lending, right, by renewing the lending, right, to the entrepreneurs, to corporations, and the interest rate is going up. Are you happy or unhappy here? Of course you are happy, right? Because the interest rate is going up and you will lend out that new loans to new corporations or new people, right? You are happy. But what about your RSL? RSL, right? The amount of liabilities that will experience a change in interest rate. So when your liabilities mature, you have to find new financing and the interest rate is going up. You are unhappy, right? You are unhappy. And you see here, your happiness is bigger than your unhappiness. That's why the aggregate effect is positive, right? So if the repricing gap is positive, your RSA is larger than your RSL. If the interest rate is going up, then the aggregate effect is positive, right? Our net interest income will go up. What about the second one? What's the second one here? The gap is positive. Again, RSA is bigger than RSL. However, now the interest rate is going down. Okay, so think about it here. In terms of the RSA, uh, we have to renew the assets and the interest rate is going down. Of course, we are unhappy, right? Because you will lend out no money to new people or new corporations, and the interest rate is going down, so you are unhappy. But for this one, of course, you are happy, right? Because your liabilities mature, you have to look for new financing, and the interest rate is going down, right? It's declining, so you are happy. However, you see here, your unhappiness exceeds your happiness, right? Your unhappy state exceeds your happy state. That's why uh, the final or the aggregate effect is negative. Okay, so what about the third one? The third one, now the repricing gap is negative, so smaller RSA compared to RSL, and the interest rate is going up. Interest rate is going up. So again, what about the its effect on RSA? So you have to renew your loans, right? And the interest rate is going up. Of course, you are happy. What about the RSL? Your liabilities mature, you have to renew your liabilities or financing, and the interest rate is going up. You are unhappy here. And which one is bigger? The RSL is bigger, so you are more unhappy than happy, right? So that's why the aggregate effect is negative toward your net interest income. Number four, scenario number four, RSA is smaller than RSL. The pricing gap is negative, but interest rate is negative. Interest rate is declining, right? So again, what's the logic here? When you want to lend out new money to new entrepreneurs or new corporations, the interest rate is declining, so you are unhappy. You're unhappy, right? What about your RSL? So your liabilities expire, you have to borrow like new financing, new debts, and the interest rate is decreasing. Of course, you are happy, right? You are very happy. And now your happiness is bigger or larger than your unhappiness. That's why the aggregate effect is positive. So we see four scenarios here, very easy to imagine. Right? Now we'll see a situation where uh, we call it like spread effect. So not only do we have the interest rate effect, right? The interest rate is increasing or declining, but now we also have the spread effect. So the spread effect is uh, very realistic and very real in real life because now the usually interest rates will go up in the same direction, right? Both for assets and liabilities, but uh, now the increase or decrease might be different, right? Again, I will repeat, okay? So usually if interest rate on assets is increasing, uh, the interest rate on liabilities also increases. However, the magnitude of the increase will be different, and so will the decrease in interest rate, right? So they might decrease, right? Or they are heading into the same direction. They are both decreasing, but the magnitude of the decrease might be different, right, between debt for assets and debt for liabilities. Okay, that's why now we have to calculate this way. So previously we are seeing that the net interest income is a repricing gap multiplied by the change in interest rate, because previously we assumed that the change in interest rate was uniform, right? Was this of the same magnitude between assets and liabilities, but now we are assuming that the change in interest rate on assets and debt on liabilities are different, right? So we multiply the RSA by the change in interest rate on assets minus the RSL multiplied by the change in interest rate on liabilities. So we see an example here. So RSA, let's say RSA is 155. The RSL is also 155. So previously we know that the repricing gap is zero if this is the case, right? Because the RSA is exactly the same as RSL. So 155 minus 155 is zero. So in our previous example, this would easily produce a zero result because the repricing gap is zero. But now we have to be a bit uh, careful because you see interest rates are increasing, right? But the increases are different, right? For RSA, the interest rate is increasing by 1.2%, while the RSL is interest rate on the liability side is increasing by only 1%. So the spread effect is 1.2 minus 1. So the spread effect is positive 0.2%. Okay. So what is the aggregate effect on the net interest income? So RSA multiplied by the increase in interest rate on the asset side, right, minus RSL multiplied by the increase in interest rate on the liability side. So they are different, right? We have the second effect called the spread effect. So the first effect is the interest rate move, right, or movement, and we are seeing an increasing interest rate. But the second effect is the spread effect. So they both increase, but the increase on the asset side is 1.2, whereas the increase on the liability side is only 1. Right? So we get positive 310,000 for the net interest income, right? The change in the net interest income. So if we summarize this one, now we have 8 scenarios and it's getting a bit more complicated. You see here, some scenarios have uncertain. So up and down, up and down. This shows that scenarios 2, 3, 5, and 8 are uncertain, right? Depending on the numbers, depending on the cases with numbers. So we cannot determine. But for other scenarios, scenarios 1, 4, 6, and 7, they are certain to show an aggregate effect on its net interest income. So we'll see. Maybe we start from the first one. Okay, start from the first one. So the first scenario shows that the gap is positive. So you could imagine the situation there. The pricing gap is positive, and actually the interest rate is increasing. So let's start from here. Okay, let's stop here for a while. Again, from the previous example, we know that uh, there's an increasing interest rate here, and the increasing interest rate for the RSA is good news, right? So you're very happy. You have to renew your loans, right? You renew your lending to entrepreneurs or people or businesses uh, at the time where interest rate is increasing, so you are happy, right? But this one, RSL, your liabilities expire and you have to find new financing. Whereas the interest rate is increasing, you are unhappy here. You are unhappy. But again, your happiness is bigger than your unhappiness. So up to this point, you are happy, right? As of this point, you are quite happy. Now we see the second effect here. The change is, so the spread is positive. So it means that so both rates are going up and the spread is positive. So you could imagine maybe a situation such as assets, the interest rate on assets is increasing by 2%, uh, but the increase in interest rate on liabilities only increases by 1%. See, the spread is positive, right? 2 minus 1 is positive. So you see, uh, interest rate is increasing and you are happy enough, right, for the RSA. And the fact shows that the increase in interest rate for assets is even bigger than the increase in interest rate for liabilities. So you are double happy. You could imagine, right? You are happy enough with the increase in interest rate, but now you find the fact that the increase in interest rate on assets is even larger than the increase in interest rate on liabilities. So you are happier, right? Happier. So double happiness. So of course the aggregate effect is positive. What about the scenario number 4? So we pursue those scenarios with certain results, okay? So scenario number 4, so the gap is positive, and the interest rate is going down. Right? So before going to the spread effect, you could imagine RSA here, uh, you will renew your lending, right? Your loans, and the interest rate is going down. Of course, you are unhappy. But the RSL, your liabilities mature and you have to look for new debts and the interest rate is decreasing. Of course, you are happy. And but your unhappiness is bigger than your happiness, right? So up to this point, you know that the condition is unfavorable, right? Unhappy to you. Now, what is the spread now? The spread is negative. So imagine, right, the interest rate is negative, declining, right? The interest rate is declining or negative, going down, right? But the spread is also negative. So this is like, you could imagine maybe the decrease in interest rate on assets is -1. It's decreasing, right? Interest rate is decreasing. On asset sides, the decrease is 1%. But on the, oh, maybe I change the number, okay, to make it easy. Maybe uh, interest rate is going down by 2% on the asset side, but it only goes down by 1% on the liability side. So you see, -2 -1 is still minus, right? So you see the what's that, the spread is negative. So you can imagine the situation, right? So they both go down, right? They are both going down, both rates go down, but uh, the interest rate on assets goes down by 2%, whereas uh, the interest rate on liabilities declines by 1%. So -2 and -1, right? -2 minus -1 is still -1. That's why the spread is called negative, right? So how about this? So interest rate on assets goes down by 2%, whereas the interest rate on liabilities declines by only 1%. So of course you are now more unhappy, right? Even unhappier with the spread effect, because the interest rate is decreasing and this makes you unhappy enough, right? But now the decrease in interest rate on assets is larger than that on liabilities, and you are even unhappier or more unhappy. That's why the aggregate effect is, of course, negative, right? Okay, what about next one? Number 6 here. Number 6. So the gap is negative. So something like this, right? RSA is smaller than RSL. And the interest rate is going up. So I think you could uh, see the logic faster now. So for the RSA, interest rate is going up, you are happy, right? Because you renew your loans at a higher interest rate. But for your liabilities, you have to borrow new financing because the RSL, because your liabilities will expire. You renew your debt at a higher interest rate. You are unhappy. And which one is bigger? The unhappiness is bigger. So you are unhappy, right? Up to this point, you are unhappy. What about the spread? The spread is also negative. So you see here, both rates go up, but the spread is negative. So this would look like a situation where, let's say the asset interest rate on assets goes up by 1%, but the interest rate on liabilities increases by 2%. So you see, this is negative, right? The spread is negative, but they both go up, you see. Interest rate, the asset interest rate on assets goes up by 1, whereas the interest rate on liabilities increases by 2%. So they both go up, but the magnitude is different and the spread is negative. So what about this? The increase in interest rate on assets is 1%, right? But the increase in interest rate on liabilities is 2%. So you become unhappier. You are unhappier, right? More unhappy. You are already unhappy here, but this makes you unhappier. So the aggregate effect is, of course, negative. Okay, what about the another scenario that has certainty here? Number 7. So the gap is negative. The gap is negative. Interest rate is going down. So you see here, you're going to renew the loans that you give to your clients, and the interest rate is decreasing. You are unhappy, right? You are unhappy. The new loans is charged at a lower interest rate, so you are unhappy. But here, you need new financing because the liabilities will mature and the interest rate is going down, so you are happy. And which one is bigger? The happiness is bigger. The happy state is larger than the RSA. And what about the spread? Spread is positive. So this is interesting, right? So both interest rates go down, but the spread is positive. So this would look like maybe interest rate on the assets declines by 1%, but the interest rate on liabilities decreases by 2%. So you see, minus 1 minus 2 is positive 1, right? So this is positive, right? So this is the situation, right? Both interest rates go down, but the spread is positive, meaning that uh, the decline in interest rate on assets is smaller than the decline uh, in interest rate on liabilities. So imagine the situation now. Uh, the interest rate on assets decreases by 1%, but the interest rate on liabilities decreases by 2%. So you are happy, right? You're happier here because the decline in interest rate on assets is only 1%, whereas the decrease in interest rate on liabilities is 2%. So you are happier. That's why you're already happy here. Here you are happier. So the aggregate effect is positive. But for scenarios number 2, 3, 5, and 8 are uncertain in the aggregate effects on the NII because they depend on the numbers, right? Okay, so we have seen some scenarios with certain results or certain direction, right? And you can see an example here. Uh, we saw it before, right? The RSA and RSL. This is the RSA, and this is the RSL. Uh, the interest rate on assets increases by 1%. Oh, sorry. Interest rates fall by 1% on RSA. And interest rate falls or declines uh, by 1.2% on liability side. Okay, so how is it here? So 155 million, 155 million multiplied by, it says falling, so it's uh, multiplied by minus 1%, at minus 140 million multiplied by minus 1.2%. And we still get a positive result of 130,000, right? So this is something, what scenario is it? The gap is positive, interest rate is going down, so gap is positive, interest rate is going down, but the spread is positive, right? Because you see here, it's minus 1, minus 1 minus 1.2, right? Is positive 0.2. So this is a case where the gap is positive, interest rate is going down, but the spread is positive. So which scenario is it? Yeah, this one, right? Scenario number 3. See here, positive gap, uh, lower interest rate, but the spread is positive. So what is the conclusion here? Uncertain, right? So it depends on the numbers, and by chance, for these numbers that we see in this example, the net interest income increases by 130,000. Also, so to end our discussion today, you'll see some weaknesses here of the repricing model. So in our next video, uh, we'll talk about more official and also more sophisticated method, which is the duration model, right, to measure the interest rate risk. But for the repricing model, you see the first weakness is we don't use market value effects because we rely on the balance sheet, right? You know that in accounting, most items are using their book values, right? Most items are recorded at their book values. So only marketable securities or for trading assets should be recorded in or at their market values. But the other items are usually recorded at book values because of the conservative principle, conservatism that we have to maintain in accounting. So again here, because we use the balance sheet, we don't really pay attention to the market value of every item here. And then the offer aggregative situation, there's an offer aggregation. So we see here, um, maybe we have this situation, right? When we estimate the RSA and RSL for 1 year bucket, uh, unbeknownst to us that the RSA for the 1 year bucket is dominated by assets from, for example, 7 month to 12 month. So the dominant items are from the uh, rate sensitive assets from 7 month to 12 month. On the other hand, for the liabilities, the 1 year bucket is dominated by here RSL from uh, 1 month to 3 months. So you see when we calculate the repricing gap for 1 year bucket, all of them will be included because 1 month is included in 1 year, of course, right? 3 month is included. 7 month and 12 month are included in 1 year bucket as well. So we see some imbalance situation here. So what is the solution here? Of course, we could say that the narrower the bucket, the more specific the bucket is, the more accurate it is. So if we are estimating the 1 day bucket, of course, this would be more specific and more accurate compared to the 1 year bucket. However, there's a trade-off here, a big drawback, because uh, if you estimate very specific buckets, 1 day bucket or 1 week bucket, you spend a lot of effort, right? You allocate a lot of resources uh, to calculating or estimating the bucket. So you can imagine that you have talented people, right? Your executive, your employees, you have a lot of talents there, and you waste your talents or your resources by asking them to calculate the buckets all the time. Actually, they have like more expertise in selling the loans or coming up with what's that the innovative ideas about new techniques, new technologies, and so forth. But you allocate their energy and effort to calculate the very specific bucket. So of course there's a trade-off, right? So if you have a narrower bucket, of course it's more accurate, but you have to spend more energy, you have to allocate more resources. So this is the offer aggregation problem. And then the third one, it ignores the rate insensitive runoffs. So this runoffs are not included into the calculation quickly, right? Because of the again the accounting system. Right? So you can imagine, right, if you lend out the money, right, as mortgages, right? You have given a lot of mortgages, and mortgage usually pays like monthly installment, right? So in the monthly installment is included the uh, interest payment and also the principal payment. So you will receive like monthly payments, right, from your clients, right, on their mortgages, on the loans that they took and everything. So monthly payments, of course, when you receive the monthly payments, uh, you will not just let them stay for nothing, right? Let them stay in the bank or uh, in the what's that in the vault, right? Your deposit vault or anything. But of course, you will immediately reinvest, right? Most likely. And you see here, uh, reinvestment becomes what? Rate sensitive because now you care about the interest rate, right? Of course, right? You'll receive the monthly payments, and these monthly payments will be reinvested, right? And so they become rate sensitive. So something that uh, cannot be caught immediately by the balance sheet because if you receive the monthly payments, it will go through your cash flow statements, right? And then your income statement, and finally your balance sheet, right? So it takes uh, some time, right, to manifest on your balance sheet as rate sensitive assets. But on the other hand, you also pay this, right, monthly payments to maybe your depositors. You see here, you borrow money or you take what's that? You take financing from depositors, right, from core deposits, and and for the time deposits, most likely you have to pay the monthly interest, interest expense, right, to your depositors, and of course, for the 1 month time deposit, this become what rate sensitive. Not only the principal payment, not only the principal payment that not only the principal that we took from the depositors, but also the interest payments, right? Or the monthly interest payment, they become rate sensitive. But again, this cannot be, this will not manifest immediately on the balance sheet. But we know that monthly we have this incomes and also expenditures in terms of monthly payments and monthly expenditures that we have to take into account, right? Because they are rate sensitive actually. And the last one, of course, off balance sheet items will not manifest because they are off balance sheet, right? They have not been material on the balance sheet. But of course, the accounting association, uh, the accounting board, always try to improve the accounting principles to make sure that even off balance sheet items could be projected or could be reflected. And I think that's the case right now with IFRS and also the GAAP, right? They try to uh, uh, make the off balance sheet items, especially the uh, derivative contracts, right? Derivative securities to manifest faster into the projected income statement, right, or something like that, right, and on the balance sheet, of course. So traditionally, we call it off balance sheet item. And off balance sheet items is uh, a contract or a situation where it has not materialized, right, on the balance sheet, but it might, right, it might be material someday. For example, we see here, we make a derivative contracts. We have special sessions on derivative securities, uh, about 6 parts, right, of my videos are talking about the derivative securities, and I would recommend that you watch them. So derivative contracts means that we make the deal right now, but the uh, implementation or the execution will happen sometime in the future. So it's still off balance sheet right now, but it might be on balance sheet sometime later. Or uh, maybe as a financial institution, you have sold the uh, performance bond, right, or guarantee or something like that, right, or loan commitment. This is quite typical financial institution business, right? Loan commitment. You see, by giving loan commitment, you stand ready to lend out certain amount of money, maybe let's say 1 million euros to one company here. So the company comes to you and uh, you make a deal with the company. So you sign a loan commitment saying that you stand ready to give a loan to the company of 1 million euros within 1 year. So it is entirely up to the company whether to draw the loan or not, right? So maybe within a year, the company only draws 500,000 euros instead of 1 million. It's entirely the right of the company because of the contract. So why do you want to do it? Of course, it's money, right? The commitment fee is quite sweet because even you do nothing, you just give a promise, uh, you get the commitment fee, right? So again, from our example here, you stand ready to lend out 1 million to the company within 1 year. If the company, if it turns out that the company doesn't draw any loan from you, then you earn the commitment fee, right? But in case the company draws like 500,000 of it within 1 year, then the 500,000 will become a loan and you will earn interest on the loan, right? So both ways you are happy, right? You get the commitment fee, even if the client doesn't or finally doesn't draw any loan from you, you still enjoy the commitment fee. You do nothing, you just give a promise and you get the commitment fee. But on the other hand, if the company finally draws the loan, then you get of course you will charge the interest rate on the drawn loan, right? Or maybe guarantee, right? You give a guarantee to a project. For example, maybe the German government uh, is making a contract with a contractor, an electricity contractor, to build an electricity system on a mountain, right? But the German government is saying to the company that it wants a guarantee from a financial institution. Then the contractor comes to our bank, right, our financial institution, and we decide to make a contract with the contractor saying that we will guarantee uh, uh, and we will pay to the German government if something bad happens to the contractor. So why do we want to do it? Again, the fee, right? The guarantee fee is quite good. Uh, Hoping that nothing bad will happen, we'll enjoy the uh, what appeared to be an easy money. Of course, it's not easy, but it appears to be, right? Because you just give a guarantee. If nothing happens, you get, you enjoy the fee. But of course, if something happens, you have to pay because you're the guarantor of the contractor. I have to pay to the German government in our example here. Okay, so it's very interesting model here, repricing model. Again, this is a classical, uh, not official model, right? That's required by BCBS, but we'll see the next model, which is the duration model, in our next video. So thank you for watching today. See you soon in the next video. Bye.